Hey, it's your man chollyP. About to go ahead and go over my omegatrade strategy. You'll find this strategy is pretty similar to killer crossover. So if you watch the killer crossover video, this strategy should be pretty easy to catch on to. But let's go ahead, jump into the first example. The first example we're looking at is going to be right here inside this box. We're looking at this formation right here. So the first rule of the Omega strategy is the H1 candles are consolidated between the 50 and 144 EMA, and the H1 wick at least touches past the 144 EMA. The 144 EMA is the purple line. And what I mean when I say, so obviously it's self-explanatory that price is consolidated between those moving averages. It can poke in and out of it. Actually, it can even completely form just outside of it, which I'm going to show an example of that as well. But ideally, we want it in between those moving averages. And sometimes you'll see price hovering between the moving averages, but it never touches the purple line. And that's what I mean by that last little part when I say the H1 wick needs to at least touch past the 144 EMA. I'm just saying we need at least, like right here, I'm not even paying attention. Right here, it's like, oh, okay, we might have Omega forming because it finally touched past the 144 EMA. But that's all the first rule is. Look for that consolidation there. Second rule, make sure the formation's diagonal trajectory calls for a break of structure. So what I mean by the diagonal trajectory, actually, let me go into the third rule first, and then we'll circle back to the second rule. So the H1 confirmation candle body closes past the last prominent point in the formation. Well, this right here is going to be the last prominent point in this formation, the top of that candle body right there. Because price is chopping here. It comes up, down, and then we get this break of structure right here on this candle. Now, let me circle back to the second rule. How do I know if the diagonal trajectory is calling for a break of structure? Well, what I mean is as you get those up down movements, the last one, since we're buying this, we want this prominent point to be lower than the one that came before it. So let me actually illustrate that here. We've got some up down action going on. Let's just say that's the break of structure. This is our last prominent point. This point is lower than the one that came before it. It's lower than this point. Cool. However, if we would have had something like this, where it was like, let's see, like that, this point is not lower than the one that came right before it. So that does not count. That's not the diagonal trajectory calling for a break of structure. So this formation would likely end up taking a turn back down. It's just something we want to avoid. And of course, in a sell example, then I would do the opposite. If we were looking at a sell example, then we would want, something like that, where this is actually higher than the last one that came before it. So that's what I'm talking about when I say the diagonal trajectory. Now let's go back to the chart. This diagonal trajectory or this prominent point is lower than the one that came right before it. So that's cool. We got this break of structure on this candle right here that broke and closed past this last prominent point. Now all of our rules are met on the H1 chart. At this point, we just need to go down to the 15-minute time frame. Okay, so now we're on the 15-minute time frame, and what we need to do is make sure that the 50, and then when we got that break of structure, by the way, we were probably about right, we're up in here somewhere at the end of London session. So at this point, we want to make sure that on the 15-minute time frame, the 50 EMA has not yet crossed over the 144 in the direction you want to trade. This is another rule that's same as killer crossover. So since we're looking to buy this, we want the 50 EMA, which is the gold line. We want that 50 EMA to still be under the 144 on the 15-minute time frame when we take the entry. So other than that, you just wait on price to come down and grab the 50 EMA. If it's still under that 144, that's where you enter. It's when price goes up under the 50 EMA. So actually where our break of structure line is, that's where in this situation we would enter that trade. So I would say enter right there where that black line is already. And you can go ahead, and that's a 100 pip day, over 100 pips a little bit. So that's one example. Let's look at another one so we can try to get this to sink in a little bit better. Here's another example of the Omega strategy at work. So we're going to be looking right here in this area here. The first rule is that our candles are consolidated between the 144 and the 50 EMA. Now, if you notice, this is pretty much an upside down head and shoulders pattern right here. This is where our structure broke, was on this green candle here. It broke past right here. I would say this would be the last prominent point. This prominent point is lower than the one that came just before it. So our trajectory is correct. Those are our first three rules already met. We got the consolidation between the 144 and the 50. Again, it can come in and out of that 144 and 50. That's fine. It's just essentially it's between those EMAs. The trajectory is correct because here's our last prominent point before we got the break of structure, and it is lower than the last prominent point that came right before that one. Trajectory is good. And of course, the H1 candle body closed past our last prominent point. First three rules are met. All we got to do is go to the 15-minute time frame and check that last rule. All right, so this is where the structure broke. So we come down, and by the time we enter the trade, is the 50 EMA still under the 144? We don't want it to have crossed over yet, and it hadn't. So you jump in the trade right when it grabs the 50 EMA. So you jump in the trade pretty much right here at when this red candle came through. Bam, you jump in. You have a little bit of drawdown, and then not that much at all, though. That's what, 14 pips of drawdown, 13 pips of drawdown, which on gold is really good. With gold, I actually use half my normal lot size, but double my normal stop loss. The reason being, gold moves a lot more than other pairs. So I cut my lot size in half, but double my stop loss. So if my normal lot size is 30 standards, I'm going to drop that down to 15 standards. And then I'm going to put a 40 pip stop loss on this instead of my normal 15 to 20 pips. So that's how I trade gold. But anyway, this one, we didn't have that much drawdown. Clearly some news hit right here. And but that's over, dang, that's 400 pips. That's a 400 pip trade. If you would have held that, but I ain't gonna sit here and lie. I'd have probably been out at the top of this wick right here with 200 and something pips. I'm not finna hold that. Once it would, yeah, that's 280 something pips. Yeah, I'd have took that. I'd have been gone. But dope trade right there. Let's look at one more example of this particular style of Omega trade. I'm gonna show you an example of one, how I mentioned that sometimes the formation can happen just outside the 50 and 144. Let me show you one of those. And actually the last one that I took was on the GBP AUD. I actually did take this trade a couple weeks back. And here's our, oh, I'm sorry. Let me make sure you know where I'm looking. Looking inside this box. So we had price, it was chopping around that 144 and 50. It's not really between it, but it's closing in and out of it enough to where I'm like, you know what, I'll let that slide type thing. So if it's happening this close to the formation, two things are going through my brain. Number one, is this about to turn into a killer crossover? That's really my first thought. But what makes me say, no, I'm gonna go ahead and take the trade is because when my confirmation candle comes down and it closes inside the 50 and 144 and closes between the 50 and 144, I'm kind of like, all right. And everything else meets where, like, here's our last prominent point. Boom. The trajectory is good because the trajectory is saying this last prominent point, since we're selling now, is higher than whatever this crap is right here. So I say the trajectory is good. We got our close past the last prominent point. All I do is go to the 15-minute time frame and I check everything else that I was just saying. So when price came back up to grab the 50 EMA, our 50 EMA on the 15-minute time frame was not yet crossed over the 144. So we're good because we're selling this one. So we want it to be still on top. So it came up, we hop in anywhere in this area. So let's just say we hop in here. You might deal with a little bit of drawdown and then you catch, there's 80 something pips that same day if you get out at the right time, or you can hold that and catch probably right around 100 pips. So let's say we got in there. If you held it into the next day, oh yeah, you can catch up to 140 pips holding that one. I actually got out that same day with like 80 pips just to throw that out there. I got out pretty much right at the bottom of that hour. So that's how I took that trade. All right, and I'm gonna show you just one more example of one of those kind where the formation happens just outside the 144 and the 50. So, all right, so we're gonna be looking right here inside this box. As you see, price was just outside the 144 and the 50 EMAs. And this is another one that's kind of an upside down head and shoulders actually, because you have, I would say this is a shoulder right here. This would be considered the head, and then it comes down and makes a second shoulder right here. But the main thing to consider when you're looking at this kind of trade or this kind of setup is that the confirmation candle, it needs to go back in between the 144 and the 50, just like this one did. So when we got this confirmation candle, it closed back in between that 144 and that 50 EMA. The last example I showed you on GBP AUD, that confirmation candle closed back in between the 144 and the 50. All right, so that's just something to point out. But back to GJ here. Now on this one, so after we got that confirmation candle, we just go down to the 15-minute time frame. Oh, sorry, trajectory. We need to make sure our diagonal trajectory is correct. Let me move this EMA out the way real quick. So as you see, when price came up, this would be the last prominent point at the top of this one right there. This is not a prominent point. This is more of a mini consolidation, in my opinion. So I would say this is the last prominent point. So this is lower than this last prominent point here. So in my opinion, the trajectory is correct. At that point, all I'm gonna do is go to the 15-minute time frame, wait on price to come back. Oops, let me put that other stuff back so we can make sure we got all our rules met. We wait on price to come back down and grab the 50 EMA, and we want our 50 to be still under the 144. It cannot yet have crossed over when we take our entry. Now, this is going to be too early in the morning for me. So actually, when this candle, which this looks like a news event, must have happened, but still, it hadn't crossed over the 144 yet. It came down and grabbed the 50 EMA. So we entered the trade somewhere down in here. You have maybe up to 10 pips of drawdown, depending on where you get in. And then you can catch just under 100 pips that same day. That's over 90 pips that same day. Of course, you see, if you held that, you could have caught a whole bunch of pips. If you'd have held it to the end of the next day, that's 200 pips right there. And it keeps going forever. So that's a 300 pip trade, depending on how you swing that. But that's another good example of that type of formation. All right, so that's kind of the normal way that I came up with the Omega strategy. I have been not seeing a lot of Omega trades recently, but in my back testing, I noticed there's another way that you can catch it, similar to the killer crossover strategy, how I noticed, because I was like, man, I'm missing some what seems to be killer crossover setups, but they're not confirming right. And then I figured out how they were actually confirming a different way that I can take them. So I figured out the same style of situation on the Omega trade. And I want to show y'all a few examples of a different way that you can say an Omega trade is confirmed. So let's take a look over here. And this brings me down to the very last rule, or the note at the bottom of the checklist. If you get a H1 railroad or spinning top reversal pattern on the third hit, then you can consider the setup confirmed, even if it hadn't closed past the last prominent point yet. The difference between the note on this one and the killer crossover, it doesn't matter what kind of reversal pattern it is. But on the Omega strategy, it has to specifically be a railroad reversal pattern, which is just a box going up and down right next to each other, just like this one is right here, or a spinning top pattern, which is essentially just a smaller or skinnier form of a railroad pattern. But let's take a look at this example here. And then I will say too, on this one, you don't necessarily have to worry about trajectory if you get this type of setup. So if you get a setup where the third hit is a railroad pattern, trajectory, you don't have to worry about that rule. So all you're worried about is that the candles are consolidated between the 144 and the 50 EMAs. You can count 3 hits to the high on this one. You can say this is 1 hit to the high. Here's 2 hits to the high. Here's 3 hits to the high. And on that third hit, you got a straight up and down candle that are this candle up and this candle right back down. And they're kind of evened out. The sizes of those candles are pretty even. That's a railroad reversal pattern. Soon as that happens, you can go ahead and jump right in. So I'm gonna go ahead and draw a line here on H1 because that's where that candle ended. And then jumping down to the 15-minute time frame, again, that's where our candle ended. You just go ahead and enter the trade because you're likely gonna already be above the 50 EMA, which we are. But all the other rules essentially go out the window because they're just kind of met by default, or at least that last rule where we have to make sure the 50 EMA is not yet crossed over. That's just going to happen by default with this trade. So you pretty much enter right here. Boom. You immediately go into profit. It comes back and puts you in 4 pips of drawdown, and then it takes off. And that takes off for 175 pips that same day. Or you can hold that and catch over 200 pips. So that was a 4 pip drawdown trade that you caught way up here. Actually, there's another one if I'm not, yep, on the same pair. I thought it was. That happened just a couple of days before that, a week or so before that, right here. So now we're going to look right here on this one. Same exact thing. You have price consolidated between the 144 and the 50. Here's 1 hit, comes down, 2 hits, comes down, up to make 3 hits. And on the third hit, we got a what? Railroad pattern. You enter the trade. Boom. You don't have to check nothing else in this situation. You just get in, and you could have caught right here. That's 245 pips on that trade. There's no point in me really going to the 15-minute time frame on this one. That's why I just went ahead and stayed right there, because you don't have to check that last rule in this situation. You just take the trade. Let's look at another one. All right. So in this situation, we're going to look here inside this box. Price is consolidated between the 144 and the 50 moving averages. We've got, I would cluster these together as 1 hit, comes down. This cluster here, I would say is kind of 2 hits, and then it comes down up into a third hit, and then we get a railroad reversal pattern. You enter the trade when that pattern closes. Boom. I'm gonna go ahead and go to the 15-minute time frame on this one, just for giggles. Because on this one, even when that closed, you're still above the 50 EMA. But again, just go ahead and take that trade. I'm not sure quite where it closed, but let's just say, for example, you did go into drawdown, 7 pips of drawdown, no big deal. And then you just go ahead, enter that trade. You can catch up to 100 pips that same day, or hold that into Asian session and catch close to 200 pips. That's 178 pips that it went down before it started going back up good. So those are just a few examples of a couple different ways you can confirm the Omega strategy and go ahead and take that trade. Hope y'all learned something. Put your questions in the comments, and I'll holler at y'all on the next video.